Welcome to The Deep Dive, the show that extracts the most important nuggets of knowledge from a stack of sources, custom-tailored for you. Today, we're plunging into one of the world's most fascinating and, let's be honest, complex tech giants, Alibaba Group Holding Limited, ticker symbol BABA.
Yeah, Bobby, definitely complex.
And the central question we're exploring today, really looking at it from a long-term value investor's perspective, is this. Is Alibaba, an undervalued titan on the verge of an AI-powered renaissance? Or is it a behemoth caught in what feels like an inescapable vice of geopolitics and competition?
Right. A real tug-of-war there.
By the end of this deep dive, we hope we'll have given you the insights into its fundamentals, its leadership, the financials, enough to help you form your own conclusion.
Exactly. And just to set the stage, our analysis is anchored to July 2, 2025. We're using the closing share price from July 1st, which was $113.97.
Oh, okay.
And yeah, we've really dug through a pile of stuff, financial filings, market analyses, industry reports, to try and pull out what really matters, cut through the noise.
Great. Let's jump right in then. Okay, Chapter 1, Business Understanding. We often hear Alibaba called China's Amazon, but when you peel back the layers, it's much more than that, isn't it?
Right, definitely. It's this sprawling digital ecosystem really built on a platform model. Connecting buyers and sellers is the core idea.
And their mission statement kind of captures that perfectly.
Yeah.
To make it easy to do business anywhere.
Yeah.
But how do they actually, knit everything together? Logistics, cloud, e-commerce? It seems like a lot.
It is a lot. Their fiscal year 2025-20 filing helps break it down. So first, you've got the Taobao and Tmall group.
Right, the core e-commerce.
That's the cash cow, absolutely.
Yeah.
The heart of their domestic e-commerce. Revenue there is mainly from what they call customer management services.
Which is basically advertising.
Pretty much, yeah, like pay-for-performance ads, display marketing for merchants on the platform, and also commissions on the sales themselves. Think of it like a giant digital mall where they charge for prime shelf space and take a cut.
Okay, makes sense. What's next in the structure?
Next up is the Cloud Intelligence Group. This is positioned as the future growth engine. It's already China's biggest cloud provider.
Bigger than Tencent Cloud or Huawei Cloud?
By market share, yes. Revenue comes from the usual cloud stuff, elastic computing, data storage, databases, networking services. But critically, its growth is now really tied to being the backbone for AI infrastructure in China.
Ah, so powering things like their own large language model, Tongyi Qianwen.
Exactly. It's becoming fundamental to the AI push.
So it's not just a separate product line, it kind of feeds back into everything else, and they're obviously thinking globally too.
For sure. That brings us to Alibaba International Digital Commerce, or ADC. This is their global arm. You got AliExpress, Lazada in Southeast Asia, Trendyol in Turkey.
Right.
Revenue here is a bit more mixed. Some platform model stuff like ads and commissions, but also increasingly direct sales and logistics services.
And speaking of logistics...
Yeah, Cainiao Smart Logistics. That's the logistical backbone for the whole ecosystem. Interestingly, it's an asset-light model.
Meaning they don't own all the trucks and warehouses.
Exactly. They mostly orchestrate a network of third-party logistics partners using data and technology.
Right.
Revenue comes from per-parcel fees and broader supply chain management solutions.
Got it.
And then there are, other segments, things like local services, digital media, and entertainment. They're more like supporting pillars for the main businesses.
You can really see that powerful flywheel effect here. The cash pouring in from Taobao and Tmall funds these huge bets on cloud and AI.
Right.
And then those AI and cloud improvements make the e-commerce platform smarter, better user experience, better monetization.
It's a self-reinforcing loop. When it works really well.
Yeah.
And just to quickly name those key platforms again, Taobao, the original C2C chaos marketplace. Tmall, more B2C for established brands, signaling trust. Alibaba Cloud, the cloud leader in China, vital for AI. AliExpress, connecting Chinese sellers globally. And Cainiao Network, the data brain behind the logistics.
When you step back and look at Alibaba's market position and just sheer scale, it's immense. I mean, largest retail commerce business globally by GMV, gross merchandise volume.
Yeah, staggering volume.
In China, Taobao and Tmall are basically essential infrastructure for retail. If you're a brand, you have to be there.
Pretty much indispensable, yeah.
And Alibaba Cloud, #1 in China and Asia Pacific, #4 globally. That's huge. And Singles Day, in fact, it generates more sales than Black Friday and Cyber Monday combined.
It really puts the scale into perspective, doesn't it?
It does.
And this scale creates that two-sided value proposition for consumers. Massive selection, competitive prices, everything, integrated payments, entertainment, commerce, and now increasingly personalized through AI.
And for the sellers, the merchants.
For merchants, access to this enormous pool of consumers, sophisticated advertising tools through Alibaba, deep data analytics to understand trends, plus seamless logistics via Cainiao, and payments via their connection to Ant Group's Alipay. It's a whole package.
So, putting it all together, what does this mean for their staying power, their competitive advantages, their moat? It seems pretty strong.
It is. You've got the strong brand recognition, particularly in China, massive economies of scale, spreading those tech and platform costs over billions of transactions.
And the network effects must be huge.
Absolutely huge.
Yeah.
That's probably the core of the moat. The more buyers, the more sellers want to be there, which attracts more buyers. It creates really high switching costs, especially for merchants who've built their business on the platform.
Makes it hard for competitors to break in.
Very hard. Plus, they have unique assets like Alibaba's data engine, Cainiao's smart asset-light logistics model, and that crucial, though sometimes complex, relationship with Ant Group and Alipay.
All of this ties into this significant strategic shift they're undergoing right now.
Exactly. Management's been very clear. The era of empire building, just acquiring everything, is over.
Yeah.
The new focus is explicitly on technology-driven internet platform businesses. So core e-commerce and logistics and AI-driven technology businesses, which is primarily cloud and AI research.
And that means selling off stuff.
Yes, they've been divesting non-core assets like the supermarket chain SunArt and the department store in time to sharpen their focus, become more agile, and frankly, probably generate some cash too.
Okay, Chapter 2. Management and capital strategy. Let's shift focus to the leadership. There was that big shakeup on September 10th, 2023. Co-founder Joseph Tsai became chairman, and another co-founder, Eddie Wu, took over as CEO. Felt like a back-to-the-future kind of move.
It really did. A return to the roots, in a way. Joseph Tsai, the chairman, he's a foundational figure. He basically built Alibaba's financial and legal architecture from the ground up.
And he's a major shareholder too, right?
He is. Second largest individual shareholder, holding around 1.4% through various entities.
Yeah.
So his financial interests are definitely aligned with long-term investors. Now, there's also been some, let's say, commentary around his public statements defending certain Chinese government policies. It highlights that tightrope walk major Chinese companies often face.
Yeah, a very delicate balance. What about Eddie Wu as CEO? What does he bring?
Eddie Wu is pure technologist. He was literally Alibaba's first programmer, co-founder, former CTO of Taobao and Alipay. He's credited with navigating their crucial shift to mobile years ago.
So bringing back an engineering focus.
Exactly. His return signals a renewed entrepreneurial mindset, as they put it, and a very clear vision. User first and AI-driven. He's seen as the guy to lead this massive AI transformation.
That sounds like management is being pretty direct about their strategy, focusing on core, investing in AI. How's their communication generally?
They have been quite direct about the strategic shift, differentiating core versus non-core assets, and they do maintain regular communication with investors through earnings calls and filings.
Okay. What about ethics and reputation? That's always a factor.
It is. Internally, their mantra is famously customers first, employees second, shareholders third. Externally, it's more complex. The issue of counterfeit goods on platforms like Taobao hasn't completely gone away, which is a persistent reputational drag.
Right.
And as we touched on with Tsai, the leadership's necessary alignment with the Chinese government on certain political issues can create reputational risk or concern for some global investors. It's part of the package.
Let's talk about where the money's going. Capital allocation. You mentioned a big pivot.
A dramatic pivot, yeah. The primary investment focus now is clear. Massive multi-year spending on AI and cloud infrastructure. We're talking tens of billions of dollars earmarked for this. It's the central pillar of their future growth strategy.
So less focus on buying other companies.
Much less. The M&A strategy has basically inverted.
Yeah.
It's gone from acquisition-led growth to simplification and focus. They're actively selling non-core assets now to streamline and raise funds.
And what about returning capital to shareholders?
That's the other side of the coin, and it's become a major focus. They have a really aggressive share repurchase program. In fiscal 2025 alone, they bought back $11.9 billion worth of shares.
Wow, that's significant.
It is. It reduced the share count by about 5.1%. And they still have authorization for another $20.1 billion in buybacks through March 2027.
It's a huge commitment, sends a strong signal.
A very strong signal. And on top of that, they recently initiated dividend for the first time. The current yield is around 1.74%.
So buybacks and a dividend?
Exactly. It's this powerful dual signal. They're saying we're still a growth story, investing heavily in AI, but also we're a value story and will return cash directly to you. Having enormous cash reserves makes this possible.
Which brings up a crucial question. How efficiently are they actually using all this capital? Let's talk return on invested capital, ROIC.
Good question. For fiscal year 2025, their ROIC was in the range of 8.5% to 9.0%.
And how does that compare?
Well, it's a steady improvement from the 5.8% they posted back in fiscal 2022. More importantly, it's higher than their estimated weighted average cost of capital, the WACC, which we estimate is between 4.7% and 5.1%.
So they're generating returns above their cost of capital.
Yes, that positive spread means they are technically creating economic value with their investments. That's a key metric for long-term value investors.
All right, Chapter 3, Financial Analysis. Let's dive into the numbers themselves. What's the overall size, the market cap we're looking at here?
As of our analysis date, July 2, 2025, Alibaba's market cap was sitting around $272.6 billion. Still absolutely massive, one of the world's largest tech companies.
So significantly down from its peak back in 2020.
Oh, yeah, quite a way down from those highs, which is central to the whole valuation debate.
Okay, let's look at revenue trends over the last 5 years. It hasn't been a smooth ride, has it?
Not at all. It's been a story of deceleration. You had explosive growth in fiscal 2021, up over 52%. Fiscal 2022 was still strong, up nearly 23%.
But then things changed.
Then came fiscal 2023, and revenue actually declined by 6.0%. That was the direct hit from the regulatory crackdown in China and broader macroeconomic headwind.
Oh, have they recovered?
They've stabilized and returned to modest growth. Fiscal 2024 saw revenue up 3.1%, and fiscal 2025, the most recent year, saw growth of 5.3%. So the bull case points to this as stabilization, a platform for future growth, maybe re-accelerating slightly.
Okay, stabilization. What about profitability? Are margins holding up or improving with this focus?
They're improving actually quite significantly in fiscal 2025. The gross profit margin expanded to about 39.9% from 37.7%.
That's healthy.
Very. Operating profit margin jumped around 14.1% from 12.0% the year before, and net profit margin saw a big improvement too, reaching about 13.0% compared to 8.5% in fiscal 2024.
So the focus on core profitable lines and cost management seems to be working.
It definitely appears to be paying off on the margin front, yeah. Shows good execution.
Now free cash flow. You mentioned it's the lifeblood, but also a point of contention here.
It really is. The 5-year trend is quite volatile. After strong numbers in FY 2021, it dropped sharply in FY 2022, recovered somewhat in 23 and 24, but then saw another sharp drop in FY 2025, down to about $77.5 billion.
That sounds alarming. Is the core business weakening?
That's the bear argument. But the company insists, and the numbers seem to support, that this recent drop is a deliberate consequence of those massive strategic investments in AI and cloud infrastructure. It's cash going out for future growth.
So a planned reduction, not a collapse.
That's the bull case interpretation, but it's definitely a major point of debate. Are these investments going to generate sufficient future cash flow to justify the current spending? The jury's still out.
Okay, so putting the pieces together, revenue stabilizing, margins expanding, but FCF compressed by investment. What's the overall picture of financial stability?
Overall, it's still very strong. Their balance sheet is like a fortress. Debt-to-equity ratio is super low, around 0.246 or 24.6%. Very conservative.
Plenty of buffer there.
Loads. And their current ratio is 1.55, indicating strong liquidity, plenty of cash to cover short-term obligations. Earnings have been volatile historically, but as we saw, net income bounced back strongly in fiscal 2025. And that new dividend, 1.74% yield, signals management's confidence in continued cash generation.
Right. Let's turn to valuation then. How does Alibaba look compared to others? You mentioned that China discount.
Yeah, it's very apparent in the numbers. Alibaba's trailing 12-month PE ratio is about 15.3x.
Which sounds low for a tech giant.
It is, especially compared to its own history and global peers like Amazon, which trades around, 36.5x PE? A huge difference.
What about compared to its Chinese rivals, JD, PDD?
Compared to them, Alibaba trades at a premium. JD.com is around 8.1x PE, PDD Holdings about 11.3x. So the market still recognizes Alibaba's stronger ecosystem and better margins relative to domestic competitors.
But still, that gap versus global peers.
That's the China discount in action. It reflects the market pricing and all those geopolitical, regulatory, and economic risks specific to China, plus concerns about the VIE structure we mentioned.
Okay. If we try to look beyond relative valuation towards intrinsic value, you mentioned discounted cash flow, DCF. Remind us briefly what that is.
Sure. The DCF concept is pretty simple at its core. A business is worth the sum of all the cash it's expected to generate in the future, but with those future cash flows discounted back to what they're worth today.
Right.
Because, a dollar today is worth more than a dollar next year.
Right, the time value of money. So what does your educational DCF model suggest for Alibaba's intrinsic value range?
Based on our analysis and assumptions, our educational model estimates Alibaba's intrinsic value falls somewhere in the range of $125 to $145 per share.
And that compares to the current price of around $114.
Correct. So it suggests the stock might be undervalued relative to this estimate. But, and this is crucial, it's just an educational estimate. And DCF models are highly sensitive to the inputs you use.
Absolutely. So what were the key assumptions driving that $125 to $145 range?
The main ones were a weighted average cost of capital, or WACC, of 5.0%. That includes a specific country risk premium added for China.
Okay.
For revenue growth, we assume 7.0% per year for the next 5 years, which is broadly in line with current analyst consensus forecasts. And then beyond that 5-year period, a more conservative perpetual growth rate of 3.5%, kind of a long-term nominal GDP growth proxy.
All right, Chapter 4. Market sentiment. This is where it gets really interesting, seeing how the market is actually digesting all this information. What are the Wall Street analysts saying? Is there a clear consensus?
Oh, there's a very clear consensus among analysts, and it's strikingly bullish. We're talking a strong buy rating.
Strong buy? How many analysts?
Out of 22 firms covering the stock, 20 rated a strong buy, 1 has a buy. None are neutral or negative.
Wow, that's overwhelming. What about price targets?
The average 12-month price target falls somewhere between $161.12 and $168.75. Based on the current price around $104, that implies potential upside of over 42%.
Huge implied upside, though the range is wide, you said.
It is. The individual targets range from a low of $103 to a high of $199. But the overwhelming message from the professional analyst community is they think this stock is significantly undervalued.
Okay, so analysts are bullish. But what about the general media narrative? Does it match that optimism, or is it more cautious?
The media narrative is definitely more balanced, maybe even leaning cautious. It often portrays this tale of two competing forces.
Oh, so?
Well, you'll see positive stories focusing on the strategic pivot to AI, signs of cloud business reaccelerating, the disciplined capital allocation with buybacks and dividends. Headlines like Bernstein upgrades Alibaba on AI optimism.
All right, bull points.
Exactly. But then you get persistent coverage of all the risks we've discussed. The health of the Chinese economy, the unpredictable regulatory environment, not just from Beijing, but EU scrutiny is also a factor now, and of course the ever-present U.S.-China geopolitical tensions. These stories constantly highlight that China discount.
So a much more mixed picture in the headlines. What about market indicators? Short interest, for example. Are lots of people betting against the stock?
Not really, surprisingly. Short interest is running at about 2.09% of the float.
Which is high, low.
It's relatively low, especially for a company facing this many headwinds and with such a volatile past few years. It suggests that despite the risks, not many large institutional players are making big bets that the stock is going to collapse.
Interesting. And technicals. What about the stock's momentum based on moving averages? Is it trending up or down?
It's giving off some mixed signals right now, which kind of reflects the market's overall indecision.
Okay.
So the current price, around $114, is actually below its 50-day moving average, which was closer to $118. That's typically seen as a short-term bearish signal, suggesting a recent loss of momentum. But the price is still comfortably above its 200-day moving average, which is down around 106 tickles. That's usually interpreted as a longer-term bullish signal. Suggests the broader trend is still upwards and that maybe a bottom was put in earlier in 2025.
So short-term weakness within a longer-term potential uptrend reflects the uncertainty.
Exactly. The technicals capture that tension perfectly.
Chapter 5. Ownership structure. Let's look at who actually owns Alibaba shares. This is often quite revealing, isn't it?
It can be, yes. And Alibaba's ownership structure is quite distinctive, especially compared to big U.S. tech firms.
How so?
Well, institutional ownership is surprisingly low. It's only around 15.1%.
Only 15% for a company that size.
Yeah, it's much lower than you'd typically see for a U.S. tech giant. The top holders include familiar names, JPMorgan Chase, PrimeCap Management, FMR Fidelity, Dodge & Cox, Goldman Sachs, but even their positions aren't enormous relative to the company's size.
And are they buying or selling recently?
It's mixed. Looking at recent filings, some have been increasing their stakes while others have been trimming. No clear trend among the big players.
So how do you interpret that low institutional ownership? Is it a red flag or?
It can be seen both ways. The bearish interpretation is that those smart money, the big institutions, are wary due to the risks to the VIE structure, the geopolitical overhang.
Makes sense.
The bullish view is that it represents an opportunity. If sentiment towards China or Alibaba improves, there's a lot of potential buying power from institutions currently sitting on the sidelines.
Okay, what about insiders, the founders, management?
This is where official numbers can be misleading. If you just look at standard filings, insider ownership looks tiny, like 0.01%.
That seems wrong.
It doesn't reflect the reality. The significant stakes are held by the co-founders, primarily Joseph Tsai and Jack Ma, through various offshore entities and trusts that don't always show up directly as insider holdings in the same way.
So they still have significant skin in the game.
Oh, absolutely. Tsai holds around 1.4%, as we mentioned. Jack Ma, although he stepped back from formal roles, was estimated to hold around 4.8% back in 2020 via his structures. Their financial interests are deeply, fundamentally aligned with the company's long-term success, regardless of what the simplified insider ownership percentage says.
That's important context. What does this combination low institutional ownership, founders holding via other structures mean for the overall ownership concentration?
It means the concentration of shares held by the general public and retail investors is exceptionally high. We're talking somewhere between 89% and potentially up to 98% of the freely traded shares.
Wow, mostly retail investors.
Yeah, largely driven by that low institutional participation. And that can contribute to higher stock price volatility as retail sentiment can swing more rapidly. And again, the likely primary reason for that low institutional number goes back to fundamental concerns about the variable interest entity, the VIE structure.
Right, that legal structure used by many Chinese companies to list overseas.
Exactly. It adds a layer of legal and political risk that keeps many large compliance-focused institutions underweight or out entirely.
Okay, let's pivot now to a formal risk assessment. Chapter 6, Risk Assessment. A SWOT analysis is always useful here. Strength, weaknesses, opportunities, threats. What are Alibaba's core strengths?
Their strengths are pretty clear. That dominant market position in Chinese e-commerce, the incredibly diversified and synergistic ecosystem we talked about, those powerful network effects creating a real moat.
Tech prowess, too.
Absolutely. Strong tech capabilities in data, cloud, and now AI, and underpinning it all, a fortress balance sheet with lots of cash.
Okay. What about the internal weaknesses?
The biggest weakness is probably that overdependence on the Chinese market and economy. It's where their strength lies, but also their vulnerability. Then there's the persistent counterfeit goods issue, which impacts trust and brand.
And the recent investments.
You think? The rising operating costs and the resulting compressed free cash flow, mainly due to those huge AI and cloud investments, are a weakness until they clearly start paying off. And finally, that complex and inherently risky variable interest entity, VIE, corporate structure, is a structural weakness from an investor perspective.
Right. Now for the external factors, opportunities. Where's the potential upside?
The opportunities are significant. There's the massive market potential in AI and cloud computing expansion in China, where Alibaba Cloud is really well positioned. International growth, especially in emerging markets via Lazada and AliExpress, is another key opportunity.
And making more money from the existing platforms.
Exactly. Enhanced monetization through new AI-powered tools, like their advertising platform, Quanzhantui, could drive revenue growth on the core commerce sites.
And the flip side, external threats.
Threats are plentiful, too. Intense and, importantly, evolving competition is a big one domestically, from JD.com, PDD Holdings, even Tencent in some areas.
Yeah.
Globally, in cloud, they face giants like AWS and Microsoft.
Always
a threat. Unpredictable regulatory scrutiny, both from Beijing and increasingly from international bodies like the EU, and, of course, standard cybersecurity risks, which are huge for a company handling this much data.
How do the broader macroeconomic and geopolitical factors play into this risk picture?
They're huge factors. The primary macroeconomic threat is a sustained slowdown in the Chinese economy.
Yeah.
If you have issues like high youth unemployment, a weak property sector, deflation, that directly hits consumer spending, which is Alibaba's bread and butter.
And global slowdown.
A global recession would definitely hurt their international commerce ambitions via ADC.
Okay, here's where it gets really specific and timely. Let's unpack the impact of those 2025 U.S. tariffs. How big a deal are they for Alibaba?
There was significant headwind, particularly for the international side. The U.S. government imposed new tariffs in early 2025, and by March, they were ramped up to a broad 20% on essentially all Chinese imports.
20%. Ouch!
Yeah. It directly attacks the core value proposition, the low-cost advantage of platforms like AliExpress and Alibaba.com that connect Chinese sellers to U.S. buyers. It makes those goods significantly less competitive. Sellers either have to eat the cost, hurting their margins, or pass it on, hurting demand.
Broader implications.
It definitely accelerates that China plus one trend, where global businesses actively look to diversify their supply chains away from China to reduce reliance and risk. That's not great for Alibaba's B2B platform either.
How is Alibaba responding?
They're trying to adapt, helping merchants navigate the complex customs issues, encouraging them to focus more on non-U.S. markets like Europe, Latin America, Southeast Asia, where the tariffs don't apply. But it's a definite challenge.
So, summing up the risk assessment, what's the core tension?
It really comes down to that duality we keep mentioning. Alibaba's greatest strength, its deep integration to the Chinese economy and digital landscape, is simultaneously its greatest weakness and source of risk due to that dependence on China's economy and unpredictable government policy.
So investing in Alibaba is almost like investing in China itself.
To a large extent, yes. It's become a high beta proxy for global investor sentiment towards China. Being bullish on Alibaba fundamentally requires having a constructive, or at least not overly pessimistic, view on the future of China's economy and its place in the world.
Okay, Chapter 7, Conclusion. Let's try and synthesize everything we've walked through. What are the key pillars supporting the bull case for Alibaba right now?
So, summing up the bullish arguments. First, valuation. It looks cheap, trading around 15x PE, a significant discount to its own history, our intrinsic value estimate, and especially global peers.
Okay, valuation. What else?
Second, that dominant economic moat, those powerful network effects, economies of scale, brand recognition, they provide real resilience. Third, shareholder-friendly capital allocation. The massive buybacks and the new dividend show a commitment to returning cash.
The strategic pivot.
Yes. Fourth, the strategic pivot to AI and cloud. It's a credible, potentially massive catalyst for re-accelerating long-term growth if they execute well. And fifth, improving financial health, specifically those expanding profit margins and the rising ROIC, suggesting better efficiency.
All right, a solid set of points for the bulls. Now, what are the key arguments for the bear case? What keeps investors worried?
The bear case is equally compelling and rests heavily on risk. First and foremost, profound geopolitical and regulatory risk. The unpredictability from Beijing, the U.S.-China tensions manifesting in things like the 2025 tariffs. This creates the persistent China discount.
Competition.
Second, yes, intense domestic competition. PDD Holdings especially has proven a fierce competitor, and JD.com remains strong. Third, that overwhelming dependence on the Chinese economy, which itself faces significant structural headwinds right now.
And the cash flow.
Fourth, the compressed free cash flow due to those huge AI investments. It's a gamble, and there's no guarantee of the returns. And fifth, that variable interest entity, VIE structure, which remains a fundamental structural concern for many large institutional investors.
So given this balance of bull and bear points, remind us one last time about the estimated intrinsic value from your analysis.
Our educational discounted cash flow model, weighing these factors, produced that intrinsic value range of $125 to $145 per share.
So what's the concluding outlook for you, our listener, trying to make sense of this?
Well, looking at the current share price, around $114, it does appear to be trading at a notable discount to that estimated intrinsic value range.
Suggesting potential upside.
It suggests potential for capital appreciation, yes. But that's predicated on being a patient long-term investor. It assumes Alibaba successfully navigates its strategic pivot to AI and cloud, and that the market's perception of all those risks we discussed begins to ease somewhat. Those are significant ifs.
And that leads perfectly into the final thought. The discount on the stock price isn't random. It exists for very real reasons, those substantial, complex, and persistent risks.
Exactly.
So the central question for you, the prospective investor, really becomes a personal one. Is the potential reward offered by this valuation gap enough compensation for you to bear those profound risks? Your answer will depend entirely on your own risk tolerance, your investment time horizon, and ultimately your own assessment of the future trajectory of both Alibaba and China itself. It's not a simple decision.
Not at all.
That wraps up this deep dive into Alibaba. We certainly hope you gain some valuable insights into one of the world's most complex and consequential technology companies.
Yeah, I hope it was helpful.
And if you did find this deep dive valuable, please remember to like this video and subscribe to the Stock Analytics AI YouTube channel.
Definitely helps us out.
For just $4.99 a month, members get priority deep dives on specific tickers you request. Plus, we're actually planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those.
Ambitious plan.
It is. And if you just want a one-off deep dive on a stock you're interested in, just drop us a super thanks on the video.
And now for the important disclaimer bit.
Yes.
Please remember, this analysis was generated by an AI system. It's intended strictly for educational purposes and should absolutely not be considered financial advice.
Definitely conduct your own research.
Please conduct your own thorough research. Or better yet, consult with a qualified financial advisor before making any investment decisions.
Thanks again for diving deep with us today. We look forward to our next exploration with you.